Good afternoon, ladies and gentlemen. Welcome to the AMINO Technologies PLC investor presentation relating to the full year results for the year ended 30th of November 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Donald McGarver, CEO, and Mark Carlisle, CFO of AMINO Technologies PLC. Good afternoon.
Good afternoon and welcome everybody. You probably can't see Mark. We're having a few little issues with his video, but he is there. He is fully dressed. He's not still in his pajamas or his jogging wear, and he will be participating as we go through the presentation.
Thank you, Donald. Yes, I'm looking forward to it.
So there's kind of three key points I'd like you hopefully to take from this presentation today. First and foremost, the software-led strategy is delivering results. In particular, our recurring revenue is up, but you'll see that all of our metrics all going in the right direction and increasing year over year, and we'll talk about that in a moment. Secondly, we launched our 2025 strategy. Yes, it is ambitious, but it also is very achievable, particularly because of the convergence of streaming services with traditional TV, an area that we positioned the company in prior to COVID. And third point is we are seeing that actually accelerating. So those trends that we saw, those growing markets that we're participating in, have only been accelerated, and it's the velocity that has improved as we've gone through this traumatic and difficult time. So as I said, key metrics all tracking ahead of prior year. Revenue is up. What we're really pleased about is that our software now almost $20 million, up 50% in the year. And within that, our ARR now up to $10.6 million, an increase of 12%. We do have a strong cash position. Our business is very cash generative. So that was up in the year. And our outlook, and combined with that strong performance in cash, gave us confidence to reinstate our dividend, which we put in place, and we'll talk about that a little bit later. Along the bottom, you'll see some client names, and I think if at 24i and AMINO Group, our vision is to make it easy for people to connect to the TV and the video that they love, and to do that anywhere, anytime, and any device. And these names are just proof of how we've executed on that vision and how our strategy has actually been effectively implemented. So if you look at Ufone is what we call an MVNO, a virtual network operator, a new entrant into the market that comes into the market with the network, and actually we provide for them all of their video services as an end-to-end solution. So enabling these kind of new market entrants to come in here and get their video and content to their customers anywhere, anytime, and in any device. Others like T-Mobile in Slovak and Czech Republic, a more traditional telco network operator. But again, they're seeing, they want to bring their services through streaming, through OTT, and we help them and enable them to do it. So we launched them as well during the year. A really interesting one is Flow Sports. It's in the Caribbean. It's part of the cable and wireless operation. It's part of their content. They're taking that content and making that available on any network, and we enable them and help them to do that. And then you get new entrants, completely new content plays coming to market, like Topic and Broadway HD, who saw really good traction and continue to see traction beyond the COVID period as well. And particularly Broadway, we saw that acceleration, or I talked about the increased velocity, where their plans really getting accelerated by the demand for these kind of services as we went through this difficult period. And how, when, and where consumers watch TV is changing quite dramatically. And our focus has been around identifying what the viewer wants. And the viewer wants that live TV combined with video streaming. It's that convergence and getting that any screen, anytime, anywhere. And we've really focused on those consumer demands so that we can help our customers, the operators, the broadcasters, and the content owners stay ahead of those demands and keep improving the profitability and the viability of their business going forward as well. And that change, as I said, is all been driven by the consumer. We see the streaming market doubling by 2025. We see streamers wanting the pay TV-like features, and we say pay TV subscribers want all these streaming features. And what we see them wanting is that best of both worlds: video on demand through streaming, etc., and live TV. And what's driving that experience and driving that demand is three things: choice, usability, and convenience. People want access to that content, wherever and whenever they want it. They want to be able to get it in a user-friendly way, in a familiar way, in a way that they can interact with it. And they want that conveniently. I mean, today, an interesting stat is that consumers are spending almost 20% of their time on streaming platforms just looking for the content. And when they do find it, is being able to find it in the format that they want to find it. And we address that market through two major routes to revenue. And again, multi-screen, that's really more aimed at our broadcasters and content providers, as well as our operators. And then pay TV plus, that's where we're helping bring pay TV customers to bring them all these streaming services in an aggregated and an enhanced way, helping them be more attractive to their customers as well. And when you look at those markets, we do split them into the broadcasters and content owners and pay TV operators, and you can see some of the kind of customers we've been supporting traditionally and more recently as well. So up there, I talked about some of those: Broadway HD, PureFlix, more recently the Canadian Hockey League bringing their content through streaming platforms, with us delivering that to a new set of customers. And then even more traditional broadcasters. So if you look at NPO, the Dutch broadcaster, the kind of BBC of the Netherlands, we've seen them bring their content to their consumers through new platforms, through OTT streaming, and we've helped enable a lot of that along with, as part of their sort of iPlayer type experience there. And I talked about Flow Sports. And then traditionally, you look down at some of the more traditional operators, so people like Consolidated, people like Go and Go Malta, now delivering a much richer streaming combined with traditional TV experience through things like Android TV that we've delivered for them into their markets and into their consumers. And basically, I did talk about Ufone. I mean, Ufone, really, when we look at our video ecosystem, we're able to provide that end-to-end ecosystem. And for Ufone, we do this manage through to watch elements we talked there. So all of the sort of framework that we talked about above, all of the offerings, app development, video delivery, the back-end system manager, device management, device software, and the devices themselves, we provide those to Ufone. But for many of our customers, we provide those elements. And we've been able to extend those elements. So people taking our app development framework, like Broadway, are now taking, some of the other elements like the video parts of the video delivery engine or our back-end system and service management. So we see an opportunity to then upsell and cross-sell some of these solutions that we've identified here. And when we look at our business model, it's really got three main elements to it. There is the recurring element, and that's the kind of most of the offerings that I talked about above. We have a part of that is professional services to support the implementation. But interestingly, we're seeing and we are transforming a shift to less professional services and more of the sort of app development framework. And we've done that through our platform. We call it the Next Gen platform. It's based on a React Native architecture and technology. And where traditionally, when you were launching an application across many ecosystems and platforms, you would do that with a lot of professional services developed on iOS, on Android, on web, on Roku, on smart TV. Whereas with our platform, you can do that simultaneously and scale that across all of these different ecosystems. And that requires then less professional services and makes it far stickier and a lot more scalable and a lot more appropriate to our customers' business. And then finally, we still have what we call more transactional or device sales. But what I would remind you, two things about those device sales is that they are integrated with a software. And whilst you look at those devices, they are really commodity devices, and it's the software that drives the value. And we wouldn't be getting the industry leading margins that we're getting if it wasn't for the quality of that software. And where we do sell the devices, we're really focused on that higher margin devices and generating further recurring revenues from that as well. And here we're just trying to lay out a little bit about the competitive landscape, so as people can kind of understand, where we are competing and where our competitors are. There's really three main areas: the video platforms, the applications, and more traditionally the devices. We also are in a fairly unique position with an end-to-end offering, the ability to offer all of these services plus the devices. And really, the only other people we see in that space are companies like our company like TiVo, who's really focused on that North American kind of tier one marketplace, and we rarely come into confrontation there. In fact, in some cases, we actually cooperate and work as partners in some of the customers, and that's one of the uniquenesses about our model: the ability to partner with some of those. And then also at times, being in an area of competition. But our focus very much in those tier 3 and tier 2 marketplace that really see a demand and a need for the services that we bring to bear. And so 2020, has been a year of significant progress operationally and more. Obviously, we talked about the acceleration for streaming services. I'm really proud of the way that the whole company has, addressed the situation. We went remote working very early on, but we continued to innovate. We didn't miss a beat. We've continued to operationally implement some really challenging and scaling implementations. And we mentioned Slovak Telecom, Cable and Wireless, Broadway HD, etc. We launched the next gen smart apps platform that I talked about, and we had that first joint customer with Ufone. And certainly Ufone is worth having a look at the quality of that service. If you go onto their website, if you do it in a Chrome browser, you'll be able to see and translate it for you, that you can see their service and get a good look and feel for how that service is. But bringing the best of streaming services and traditional TV in a very competitive way to the marketplace. One of the areas we do have a cloud-based SaaS platform for managing devices. And as we went through COVID, in discussions with many of our customers, I actually found out that one of the challenges is they were unable to get remote access to their customers to be able to support, to manage, to upgrade some of the devices that they had in their homes. And so that lent us to go to them and say, well, listen, why don't you use our management software? And that Engage Manager software allows them to manage, to upgrade and to analyze those devices and actually take control of those devices. So after sort of giving that to them, as we came out of the first lockdown, a lot of our customers turned around and said, we've found this really valuable, and now we'd like to use that. So we have seen a fairly significant uptick in take up of that service, but we're also able now to expand that service to new areas around analytics to help our customers and provide more value. So we see that as a much larger opportunity going forward. Whilst it's small in revenue today, we've really seen that take off during this period. And then finally, we talk about a partnership program, but I think just digitally, we've had to up our game in marketing. There's no trade shows anymore. It's certainly helped that we have a good presence in the marketplace. It's certainly helped us that we've invested a lot and we're well known in our marketplace across both 24i and AMINO. but we've really upped our game in terms of digital presence to make sure that we are generating leads from that. And if you go to our websites, it might not be exciting to you as investors, but certainly we've found a way to engage with our customers, to bring them in, have a discussion, and be able to, generate leads and opportunities and help and support them through that digital presence as well. So I'll hand you over to Mark, who can talk a little bit about some of the KPIs.
Thanks, Donald. I'm still here. Sorry you can't see me. So what we track in the business are key performance indicators. And what we can see is that all our key performance indicators are tracking well ahead of the prior year. Donald talked about our software and services versus devices. And when you look at our business now, 40% of our gross profit, which you can see in our account, is now generated solely from software and services revenue. And you can see in terms of the quality of our revenues on the left-hand side, we're now at 24% software and services revenues. And we've increased our annual recurring run rate revenue 12% this year, up to 10.6 million. As a result, we've increased our gross profit margin up to 48%. And we continue to focus on and generate good operating cash flows, with our adjusted operating cash flow up to 18.2 million. Moving on to our revenues, we highlight here that we're very geographically diverse. We don't have any material revenues in the UK, and we're not impacted by Brexit in that respect. So we have most of our revenues now in Europe. We've seen good growth in Europe through the likes of Ufone and T-Mobile. And you can see in our accounts that our revenues from the Netherlands region have grown significantly. We have seen a small decline in our North American revenues, partly due to devices that we sell into hotels and into stadiums being impacted by COVID, but also a decline in the average selling price. As Donald mentioned, devices are getting lower cost now with all the video recording capability moving into the cloud. And so we have seen an increase in the number of devices we sell, but the average selling price has come down. In terms of our gross profit split, I mentioned earlier that 40% comes from the software and services side, but we do sell high margin devices, as Donald mentioned, and the value of those devices is in the software that's delivered on those devices into the customer ecosystems. And we do see device revenues, although they're not recurring, as being very repeatable and very sticky. And we have a very, very high percentage of repeat orders from customers each year. We split our numbers down into our business units, our AMINO division and our 24i division. And on the right-hand side, you can see that the AMINO revenues were broadly flat year on year, and that's in spite of the impact of the enterprise market and COVID. And on the right-hand side, you can see growth in 24i. The actual underlying organic growth rate in 24i was 10%, not quite as high as we expected, but we saw really good growth from existing customers as their volumes really increased during the year. And we did still sign 6 new customers in the period and deliver them, although growth from new customers was slightly behind budget. In terms of the full income statement, we can see revenues increasing by 7% to nearly 83 million, the resulting increase in gross profit from that revenue growth and from our margin increase as a result of the high margin revenue being sold, and our adjusted EBITDA margin now 20%. For the technical accountants amongst you, you'll note that IFRS 16 impacted our EBITDA and depreciation by 1.2 million, and our adjusted operating profit was up on last year to $10.5 million. The exceptional items that we report back there, one is a credit where we've released a potential liability from previous years, renegotiating royalties and licenses. And then another is a cost, which is the 24i deferred consideration, which we account for as remuneration in the P&L. In terms of our effective corporation tax rate, you'll see on the next slide that our cash tax in the year was 1.4 million. We've now used up our previous tax losses in the UK, and the profits from the AMINO division are run mostly through the UK in terms of IP held. In terms of the 24i division, we have tax losses in the Netherlands, and those will start to be used once 24i becomes profitable in the coming years. You can see on this slide, in terms of cash flow, our net cash from operations up to 15.4 million. The exceptional cash costs there relate to the deferred consideration I mentioned earlier, which is accounted for as remuneration. We continue to invest in our products and services, and the capitalized development costs there of 5.5 million are broadly split 1/3, 2/3 between the AMINO and the 24i divisions as we invest in innovation in those companies for the future. And we've repaid our bank borrowings in the year, so we have net cash at the period end of 9.5 million. I think importantly, you can see our free cash flow up to 9.3 million this year, and that's up from 8.2 million in the previous period. Finally, on the balance sheet, you can see the impact of IFRS 16 there on the lease liability and right of use assets coming in, and that deferred tax asset now utilises the losses in the UK have been used up. I think the most important thing is to show that we've maintained good control over our debtors, the debtor days at 23, and again that net cash of 9.5 million being shown there. And then on the final slide from me, just showing that we've got sustainable growth in the business. So if you go back to when I joined actually in August 2016, we had a very relatively low level of software revenues, and we've grown those both organically and through M&A over the period up to now 19.5 million. And we see that we're now at an inflection point where we're taking advantage of that convergence of streaming and pay TV in our growth markets, and have now returned the business to sustainable growth.
And so we did also announce our 2025 strategy. It is a very ambitious strategy, to achieve this $250 million revenue by 2025. And within that, the majority coming from software, and within that, the majority being recurring revenue in nature. Yes, it's an ambitious plan, but actually now that we are focused very much in what we see as a growing marketplace, we believe with the solutions and the software that we have today, we certainly have turned that inflection point, and we've got that opportunity to grow quite significantly. Our focus is around the sort of roadmap of consumer experience, and I talked about choice, usability, and convenience. And we think data-centric products, AI data and analytics actually driving that will underpin that growth organically. But we do see a large part of that coming from M&A to further underpin the growth, and we're confident with the track record that we have in our M&A, and also the sort of marketplace out there that represents a decent opportunity. So I know that one of the questions is, where would you look to source that from? So we've tried to sort of put out the ecosystem, the landscape, and I show here where our current solutions, AMINO and 24i, where we participate, where we've got partners, and where there is gaps. And we see opportunities to fill those gaps through some M&A, to potentially strengthen the position where we're using partners, and also some consolidation within our space, either from customers or market. And we see those as being very realistic opportunities. Some of these will be bolt-ons that we'd be able to do within our own means, and some of those obviously we'd look to go to the marketplace or take on a conservative level of debt as well.
In terms of our capital allocation, we've shown on the slide here where we generate our cash and how we use our capital. So as I mentioned earlier, we had free cash flow in FY20 of 9.3 million, up from 8.2 million in the previous year, and we have net cash of 9.5 million. We have a committed facility with Barclays of $15 million, an agreed accordion of $10 million as well, giving us access to good capital from our friends and supporters at Barclays. We aim to return capital to shareholders, and we announced a new dividend policy of between 33% and 50% of adjusted EPS being returned to shareholders each year. And we aim that to grow as a dividend through growth in profits, but also increasing the range up from 33 to 50. As I mentioned earlier, we also allocate our capital to innovation and product development in the range of $7 million per annum. This year we did 5.5, and that will increase slightly next year. And we also aim to use our funds in terms of debt and also raising equity for strategic, accretive M&A that aligns with our strategy.
So just moving on to the outlook, I think overall, I mean, first of all, as I said, we've really repositioned the company into some really strategic areas of growth. And overall, more people are watching TV and video, and they're spending more time and more money on that TV and video. We think we've gone into this year with an enhanced pipeline. We think that the 2020 performance, gives us the opportunity ahead. And we're really focused on software and growing that recurring revenue. And, with that 2025 strategy in place, again, that gives us, a bit of visibility ahead that we think we can take advantage of the opportunity. And we believe we're in a good position to capitalize on that. So in finally, summary, it's the software-led business has delivered results. All of our metrics are up. We think the structural shift puts us in a good position to take advantage of it. And the market itself that we're participating is growing and growing quite significantly. And we'll do that through organic and M&A strategy to achieve that growth. So again, feeling pretty positive and well-placed to actually capitalize on the opportunity that we see ahead of us.
That's great. Thank you very much, Donald. Thank you, Mark. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand side of your screen. But just while the company take a few moments to review those questions submitted by investors already, I'd like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. Lastly, before I hand back to Donald and Mark, I'd like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you will be redirected for the opportunity to provide feedback in order the company can better understand your views and expectations. Donald, Mark, perhaps before we look at the questions from the live event, we could look at some of the pre-submitted questions by investors ahead of today's event. Perhaps I could start with the first one here, and perhaps address this to you, Donald. What opportunity most excites you for AMINO in 2021?
Well, for me, it is the strategy. We've looked at the marketplace, we see where the growth opportunity is, and being positioned now in an area where there is growth and a bit of a tailwind, that gives us confidence, and we find that quite exciting. So I see that as the kind of the main thing.
Fantastic, thank you. The second pre-submitted question we have here is, how many software developers are part of the AMINO team?
Oh, good question. I'd need to go and just identify unless Mark's got it to hand, but the majority of our people, we're just over 300 employees. And over 200 of those are in software development and development and support. So most of them, I would say, over 2/3.
Yeah, that's right. Yeah.
Thank you. And something you've touched on, obviously, during the presentation, and touched on just briefly a couple of questions. But what's your pipeline of M&A opportunities like?
Yeah, I see we've got one in there as well. So it's interesting because M&A is, it doesn't actually just happen overnight. If you look at historically the acquisitions we've done in the past, the Entone, the larger ones, Entone one, that was over 4.5 years from getting to know each other to actually getting that done. 24i, I'd known them for 3 years. So over the last few years, we know our marketplace pretty well. We've been engaged with a lot of people in the marketplace. And so the pipeline is extremely strong. And I think COVID has possibly strengthened that. Some valuations, not all of them, have become a bit more realistic, and we believe a bit more achievable. And we've had engagement with a lot of people, and I think many of them share the same sort of goals and opportunity. And I believe we'll be able to bring that into play and take advantage of some of that pipeline.
That's great, thank you. And the final pre-submitted question we have here, in terms of outlook, what gives you confidence in 2021?
The growth markets we're in. We are in areas where there is growth and there is opportunity, and we've got a strong pipeline. The performance in what was probably one of the most challenging periods, last year, gives us a lot of confidence this year as well. And we've got a great team behind us actually executing well on that. and we've got a great set of customers, existing customers, and a good pipeline of new customers as well.
Thank you. That's fantastic. I know I haven't given you perhaps too long, guys, to have a look at the questions. We had a fair few that have come through, but if I could just direct you to that Q&A tab and perhaps ask you to start at the top and answer those questions where it is appropriate to do so. If you wouldn't mind reading them out, that would be fantastic.
I've got while Donald, you look at the difficult strategy ones, I've got a couple of technical accounting ones I can quickly go through if you want. So Keith, I'll praise you this. Keith has asked that our costs have gone up and very little of our increased revenue has dropped through to the bottom line this year. And will R&D and operating costs continue to increase at the same rate as sales increase? It's a good question, Keith. We have actually improved the profitability of the Amino division if you look in our segmental analysis year on year. And in terms of the 24i division, there's been an impact of the acquisition account because obviously we've only had 4 months of it in 2019. What we are doing in the 24i division is we are growing that ARI. In fact, both divisions we're growing that annual recurring revenue. And Donald also talked about the productization of the next gen platform, which is a configurable rather than customizable platform that will drive our margins forward. So the answer is no. We do aim to increase profits, and we have a clear product strategy and commercial strategy to do that with recurring revenue and productized software sales. And then the final technical question was a capitalized development question. So given that software development maintenance is ongoing and never ending, to what extent do we think this can be justified, and how do we amortize these costs? Another good question, Quentin. We do have software development and maintenance costs going through the P&L, so maintenance costs do go through the P&L. The development costs we are required to capitalize by IFRS. It's a requirement. We don't choose it. And that is on ongoing product development and new products. We amortize that, however, pretty quickly. So in the Amino division, that's amortized over 2 years. And in the 24i division, that's amortized over 3 years. So we tend not to get a very big benefit in the P&L, if any at all. So that all washes through in depreciation and amortization. I think those are the technical accounting ones I can see, Donald.
Well done. So let me go to some of the more difficult ones. So I've got one here from Mazen who says, how can we have confidence in the 5-year strategy of more than doubling revenues when the new forecasts in the market are conservative? Well, I don't think I wouldn't ask anybody who's got forecasts out there to build in M&A, because obviously any M&A that we do, it has to be the right M&A at the right valuation. And what I would say is, as I said before, I think we've got a good track record in that respect. I think we're quite sensible in what we do, and I think we've got a clear strategy. And that the strategy is we have looked at the market, having repositioned the company into these areas. We see a real seam of opportunity for growth. So we think we're able to follow that opportunity and to be able to take advantage of it. So we have a high level of confidence in our ability to execute on that over the next 4 or 5 years. Next one I've got is from same person, is how large are the acquisitions that you look at relative to Amino's market cap? And how do you plan to finance acquisitions? Will you use debt, equity, or a combination? Well, let me talk about financing that first. I mean, clearly through some of the bolt-ons, and Mark talked about the capital allocation, but we do have access to some capital. We do have a decent cash balance. We are very cash generative. So we think we can do some of those off our own steam, a bit like we did 24i, which wasn't, an insignificant acquisition, and we did manage to do that on our own resources. However, obviously, if we do something more meaningful, we'd want to do that with a little bit of debt. We're quite conservative, maybe 1.5 times EBITDA, and some equity as well. So we'll do a sort of combination of things. And how large are the acquisitions? Well, it will depend where we are. I mean, but we look at opportunities. Software revenues ranging in the 10 up to the 14, potentially $50 million of revenue. And we could get some of these if they're the right valuation with the right accretion level that makes sense both for our customer targets and also for our shareholders. So I think we'll look at that and make sure that we do the right acquisition and the right size of acquisition. One other question: would you license your software to other device manufacturers? Yes, and yes, we do. We do license our software. One of our customers, PCCW, we license that to an ODM, and we license it to the ODM, and we also license and manage that software directly with PCCW, Hong Kong Telecom. And we'd like to continue doing that and do that even in even greater volumes, because our device is really focused on those sort of higher value but lower sort of volume opportunities for our tier 2 and tier 3 customers. We could get larger tier 2 and tier 1s by licensing that software, and that's something we continue to work on with a number of opportunities.
I've got a couple of other good revenue questions, Donald. Do you want me to take those? So I've got a really good question from Andrew at the bottom. How do you differentiate between repeat and recurring revenue, as surely most of your device revenue is quasi-recurring? And then Stephen's also asked, can you delineate terms and accounting of a typical agreement to explain the increase in recurring income? I think probably worth just me elaborating on how we define recurring revenue. So our recurring revenue comes from contracted licensing, maintenance, and support on either a single year recurring or a multi-year basis. And so we're pretty purist in terms of our recurring revenue accounting. We do, however, have a significant proportion, a very high significant proportion of our revenue of repeat orders, both on the device side, but also on the professional services side in the 24i business that's repeat and in some cases contracted. But we don't call it recurring because that's not typically what analysts in our industry call recurring. So yes, a high proportion of our business is repeat, and that's how we delineate that. In terms of sort of accounting for recurring revenue, well, typically we will bring a customer on board on one of our SaaS platforms, be it our device management platform, our 24i Smart Video or apps platform, and there will be, in some cases, an element of professional services and setup fees. But once that service has gone live, in fact, sometimes before it goes live contractually, we will account for the revenue in terms of license and maintenance on an ongoing basis. And once that's being accounted for in that month, that will then feed into our annual run rate recurring. And what we've seen over the past year is that run rate recurring go up for new customers, but also from existing customers, where we're selling on main license and maintenance on a flat fee plus a per subscriber basis. We will also see that go up as existing customers become more successful.
I've got one here from Quinton. The integrated end-to-end nature of the AMINO package sounds very attractive proposition. To what extent is sales generation a matter of pull rather than push? Well, I mean, clearly there is. Well, some of it actually. So if you look at Ufone was actually a cross-sell. So I think when you do acquisitions, people always talk about cross-sell, but you never hear much about it. But in this case, we had Ufone. We were engaged with Ufone looking at devices, and 24i was engaged looking at the client application. And what we managed to do is, by showing how we could combine the product set and combine our capabilities, we were able to offer them that end-to-end video delivery platform, all the client applications and the devices and the management and support of those devices in the back end. So we see that as a very attractive proposition for small and medium-sized, particularly operators and people like Ufone, new operators coming to market, and some of the other operators that need to try and get some scale. So there's an element of push, I think, as you put it, in that. We're able to, go out there and actively sell, and we will look to expand our market presence, particularly with that solution. But there is an element of pull that when we're actually in there selling bits of the offering, and particularly at that client front-end application and our app development framework, that gives us the opportunity to then sell more of our end-to-end platform into those customers. And that's what's happened at Topic and Broadway HD and PureFlix. We're now selling more and more of our solution into their ecosystem. And we hope to expand that. And when we don't hope to, we are expanding that. Mark, you got another one?
No, I think we're okay. I think we're just finishing up on time as well.
Covered that, the potential acquisitions.
I think you have pretty much covered off all those questions that you can from investors there, Donald. Unless there's anything else you can see that you can answer.
Just one more. There's one there. Is it a deliberate policy to concentrate in tier 2 and 3? And if so, why? And surely tier 1 will be a large chunk of the addressable market. Yes, it is a deliberate policy. Tier 2 and tier 3 are underserved in the marketplace. Tier 1 is overserved. They've got lots and lots of people chasing their business, and it's very aggressive. And we've seen that, across. Now, we are able to participate much more in tier 1 now with our software offerings. So again, I would classify NPO and T-Mobile as tier 1s. So we are making more traction in there in elements of their solution. So we'll definitely see that happen. But tier 2 and tier 3 is definitely our sweet spot, and that's where we feel the opportunity, a bigger opportunity is for us.
That's fantastic. Thank you, both Donald and Mark. I think you have answered all those questions you can from investors. And of course, the company will review all questions submitted by investors today, and we'll publish those answered back on the Investor Meet Company platform. Donald, perhaps before I just redirect investors for feedback, could you ask for a last couple of words just to wrap up, please?
Yeah, no, as I said, look, hopefully from this you saw, the three key points. The software-led strategy is working. We're delivering the right results. We're increasing our ARR. We're now engaged in what are growth markets, and we think those growth markets are accelerating. And we're excited about the 2025 plan because again, we're often running organically, but we see that opportunity for targeted M&A as well. So thank you everybody for your time, and appreciate you all participating.
That's great. Donald, Mark, thank you very much for updating investors today. Could I ask investors not to close this session, as you will be automatically redirected for the opportunity to provide your feedback. If you've accessed the meeting via our website, the page will appear in front of you. If you've accessed from the link sent to you in email, you'll be asked to submit your feedback just by logging in, which takes just a couple of seconds. On behalf of AMINO Technologies PLC, we'd like to thank you for attending today's presentation. That concludes today's event. Thank you very much indeed for attending.